How to protect your investment portfolio in 2025. Our economy could be heading towards the absolute worst case scenario, stagflation. The stock market just keeps on going lower every day, inflation is rising, and the Fed might not be able to fix it this time. So, what should we be doing? In this video, you will learn how to protect your investment portfolio using two crucial investing concepts, portfolio rebalancing and sector rotation. If you're new to this channel, I'm Eric Pan, aka Ericnomics, a full-time investor and educator. By the way, I recently got invited to take a tour of the New York Stock Exchange. It was a super cool experience, and I even got to meet the legendary Einstein of Wall Street. I'm not sure how many of you guys are interested in hearing about my experience on how I got invited, how it feels to be inside, and some interesting stories about my visit. Consider dropping a like and commenting NYSC if you're interested. Let's quickly understand what stagflation is so you know what kind of macro environment that we're currently facing. Stagflation is the worst economic scenario. It's when both inflation and unemployment are high at the same time. This is a big problem. Normally, the Fed can raise interest rates to cool inflation or lower the rates to boost unemployment. But when both inflation and unemployment rise together, the Fed is stuck. The main tool in their arsenal of adjusting interest rates doesn't work as well. This has only happened a few times in history. Each time investing becomes extremely tricky. Back in the 1970s, the US was facing high inflation, slow growth, and rising unemployment. And it started with an oil supply shock causing oil prices to skyrocket. Everything got more expensive and wages couldn't keep up, and government spending made inflation worse. Businesses struggled, people lost their jobs, and the economy was stagnant. To fix it, the Fed took bold action, raising interest rates to over 20%. It caused a short but painful recession. But over time, prices stabilized, oil became cheaper, and the economy recovered by the mid-1980s. Now, I want to be very clear, we're not in stagflation yet, but warning signs are popping up. Unemployment is still at historic lows, but creeping up. Inflation is rising again, partly because of new tariffs. Growth is slowing, and some sectors are already feeling the impact. So, what does this mean for you as an investor? You need to be prepared. You need to take action right now and know how to protect your portfolio in case if stagnation really does kick in. If you're new to investing, this is the best market environment to learn how to manage your portfolio with cautious risk management and strategic thinking. I believe that beginners learn the most in tough markets rather than entering a hot market where everyone's just buying blindly. That develops the wrong mindset with no risk management. So, I'm going to be breaking down on how I'm rebalancing my portfolio, why I'm trimming my tech stocks, and what defensive stocks I'm buying. Do me a favor, drop a like and hit that subscribe button, and let's get into it. How do you rebalance your portfolio? Rebalancing means just adjusting your investments based on market conditions. Think of your portfolio as a basketball team. When you're winning, you don't really want to change much. But if conditions change, like injuries or tougher opponents, you adjust. And that's how rebalancing works in investing. Right now, the economy is shifting towards possible stagflation. Interest rates are rising and inflation is rising and growth is slowing. The stocks that performed well back in 2023 to 2024, especially tech stocks like Tesla, Microsoft, and Meta, may not be the winners anymore. And that's why I'm starting to trim my tech stocks. In 2025, you can literally get notified whenever I buy or sell stocks completely for free. Just download the free Blossom social investing app, link in the description down below, and follow me on my portfolio. I love tech stocks, but things are changing. Many are priced for perfection, meaning that they trade at high valuations based on high growth expectations. But in stagflation scenario, that growth is less likely. That means overextended stock prices in tech could react more aggressively to negative news. Higher interest rates, slowing economic growth, and weaker earnings could mean lower profits and more layoffs. Historically, when rates rise, tech stocks fall hard. So my defensive plan is to rotate some of my money into more stable and defensive sectors that hold up better during times of uncertainty. Let me show you exactly what I'm watching and why these sectors can help you protect your portfolio. In uncertain markets, whether it's stagflation, higher rates, or slower growth, you want stocks that provide stability and cash flow. Number one, healthcare, a recession-proof industry. People don't stop going to the doctors or buying medicine just because the economy is slowing down. Pharma companies, healthcare providers, and insurers keep making money regardless of the market conditions. Now, if you're a beginner, considering adding a healthcare ETF like VHT, which is Vanguard's healthcare ETF, to your watch list. I own a small amount and plan to continue to add more as the market stays volatile. If you prefer individual stocks, consider United Healthcare Group or Johnson & Johnson, a popular dividend stock. The second defensive sector in my investing plan is the utility sector. Utilities are a bit more stable and consistent, considering that everybody still uses electricity, gas, and water regardless of whatever the economy is doing. It's a basic living necessity. One thing I do want to point out is that energy stocks tend to do well when inflation is high, because oil and gas prices usually rise during inflationary periods, which means higher revenues for energy companies. Now, energy isn't exactly the same as utilities, but they are adjacent to each other. So there's still a bit of a correlation, but energy stocks still tend to be a little bit more volatile. I don't own any individual utility stocks, but I do own a little bit of XLU, which is the utilities ETF. My third defensive sector is consumer staples. It's important to know the difference between consumer staples and consumer discretionaries. Consumer staples are things that you absolutely need, like groceries, toothpaste, hygiene products. You get it. Consumer discretionaries are things that you don't absolutely need, like expensive clothing or TVs. Consumer discretionary tends to do well during economic expansions, while consumer staples are steady regardless of whatever the economy is doing. A couple of good consumer staple stocks are like Costco, Walmart, and Coca-Cola. But I don't personally own any of these, but I am looking to add some in my portfolio soon. And finally, gold. Gold is a safe haven that investors tend to flock towards in times of uncertainty. Now, you could own gold in your own portfolio through an ETF like GLD, which is the one that I personally own. Now, pay attention. I'm not going to go all in on defensive stocks. My game plan is a balance between offensive and defensive. I'm shifting a portion of my portfolio to sectors that hold up well during uncertain markets. And I still believe in tech long term, but I need to be more selective and reducing my risk where needed. If we enter stagflation, these sectors can help cushion the downside of tech stocks that I'm holding, while still allowing me to capitalize on opportunities when the markets turn around. So, to protect your investments, do these three things. Number one, trim risky, overvalued stocks. You don't have to sell all of them. Number two, rotate into stable cash flowing sectors. 3, stay observant and patient. The best investing opportunities are very likely coming from your everyday purchases and services. And don't chase what other people are buying, and don't panic while others do. Markets moves in cycles. What has worked the last few years may not work this year. If you're a long-term investor, it's all about staying ahead of the trends and positioning yourself wisely. I have a structured investing program where hundreds of like-minded investors share their insights and investing strategies with each other. If you are looking for real-time investing guidance and portfolio reviews, feel free to check out the program, link in the description down below. I'm Ericnomics, thanks for watching. Subscribe to this channel if you like what you learned today, and don't forget to drop a like and leave a comment, and I will see you in the next video. Warren Buffett's investing advice for 2025. Do this now. Has the bull market finally ended? What should you do now? Can you still make money? I've been investing for almost a decade right now, and honestly, I'm feeling pretty optimistic because 2025 could very well be the start of a completely new cycle for you and I to build generational wealth. And here's why. Historically, whenever Warren Buffett acted carefully, like trimming his stock positions or issuing warnings in his annual shareholder letter, what came afterwards was a period of market caution. During the 1999 dot-com bubble, amidst of soaring technology stock valuations, Buffett warned us that our expectations were overly optimistic. And what happened after was 3 consecutive bearish years from 2000 to 2002. In March 2008, about 6 months before the biggest financial disaster in history of the US stock market, Warren Buffett warned against the overusage of derivatives because of the increased leverage and risk in our financial system.